Are you a farmer in Ontario thinking about selling your land, buildings, or other farming assets? Did you know that you could save big on taxes with the Farmers Capital Gains Exemption? Hi, my name is Michael Brewitt, the owner of Brewitt Financial, and I'm here today to teach you about the Capital Gains Exemption in Canada and how it could save you a lot of money. It always amazes me how many people don't know about this tax exemption or don't really know how it works. It's an important part of your succession planning process, and since our goal at Brewitt Financial is to educate and empower you in your succession planning journey, I thought this was one important topic to cover. So let's break it down so you can make the most of this valuable tax break. This exemption is part of Canada's Lifetime Capital Gains Exemption, and it lets farmers reduce or even eliminate the taxes they pay on profits or capital gains from selling certain types of farming property. As of 2024, Ontario farmers can exempt up to $1 million in lifetime gains. So let's see how this works. When you sell a property, the capital gain is the difference between what you sold it for and what you originally paid for it. It's also referred to as the adjusted cost base. Normally, 50% of that gain would be taxable, but with the Lifetime Capital Gains Exemption, you can exclude up to $1 million of qualifying gains in your lifetime. But not all farming property qualifies. To use the exemption, the asset must be considered a qualified farm property, or QFP. So what does this mean? Well, qualified properties can include land and buildings from farming, shares in a farm corporation, or interest in a family farm partnership. But there are two key conditions that must be met. One, you or your family must have used the property primarily for earning farming income. And two, it must have been owned for at least 24 months before the sale. For example, imagine you're selling your farmland. You've owned it for 10 years and it's been used exclusively for farming. Then it's likely eligible. But if you rented it out for non-farming purposes, it might not qualify. That's why it's critical to keep detailed records. Let's look at a simple scenario. Let's say you sell your farmland for $1.2 million and your adjusted cost base is $500,000. That's a $700,000 gain. Normally, you'd pay tax on 50% of that gain, or $350,000. But if you apply the Lifetime Capital Gains Exemption, you could exclude the entire amount from your taxes. To take advantage of this exemption, planning ahead is key. Here are some tips for you to keep in mind. Number 1, keep proof of the farming use and income to verify the eligibility. Number 2, split gains among family members to maximize their exemptions. For example, if a farmer is owned between 2 spouses, then both spouses are eligible for the $1 million exemption. Number 3, for farm corporations, make sure to structure your shares to qualify for the exemption. Whether you're retiring, selling to reinvest, or passing the farm to the next generation, the Farmers Capital Gains Exemption can save you thousands, keeping that money in your pocket and out of the government's. But don't forget, you will need professional advice to help you navigate the complex rules and optimize your tax savings. If you would like to learn more about how this exemption could affect your overall succession tax burden, then reach out to us at Brewitt Financial, and we would be happy to go through the numbers with you. We want to educate and empower you so that you can make the best decision for your family.